after 11 o'clock in the morning, so very much morning for me. Let me see. I'll just pop up my screen first. Get started. Some slides here for you. Sorry if my Zoom face is putting anyone off here. So hopefully you can see those. I'll just test with my panelists. Actually, just give us a little thumbs up if you can see those slides okay on the screen, and you can hear me okay as well. Okay, that's great. So, well, good evening, everyone, or good morning, as I say. What I was going to do here is throw a spotlight on estate and tax planning, and particularly from the perspective of the global expatriate, which is very much the client segment that both GFC work in as advisors, and my company, Friends Provident International, as a product provider to firms like GFC. We specialise in that sort of multi-jurisdictional global expatriate space, and I thought I would sort of look a little bit at what the current situation with COVID-19 has done. Looking forward as to what that might mean for the global expat. I did a presentation about probably a couple of months ago, and these headlines were very much in point at the time, and I was kind of hoping that I would have something new to talk about, or that the position might have changed. But at that stage, various jurisdictions were starting to move out of lockdowns as they emerged from the initial crisis. But unfortunately, since then we've seen that as soon as the lockdowns open up, that this virus does return again. So there are very few places in the planet that haven't been affected by it, if not once, but maybe twice or even 3 times now. I mean, we're actually in the fortunate position in the Isle of Man that we don't have any coronavirus here, and haven't done for about 3 or 4 months. So, but we're very cognizant that as soon as we open up, that will change. So, as you can imagine, as over the last getting on for 6 months now. I've come across lots of clients with lots of stories to tell about how they have been impacted by the coronavirus controls that have been put in place around the globe. Not least, even people that I work with who maybe travel from, who live across the causeway in Malaysia, and then were unable to travel into Singapore to do their job on a day-by-day basis, or even worse, they've had to make the decision to come into Singapore through the lockdowns and not see their families for months, and that's kind of something that's been repeated throughout our client base, and I thought I would sort of illustrate a couple of examples, because it's bringing in particularly people who are high net worth or high earners, enjoying that sort of expatriate status while they live abroad. From a tax perspective, it's throwing up some tax questions for them, and I thought I'd use a couple of examples just to illustrate. One is a typical British expatriate long-term in Singapore, and this equally could be an Aussie, for example. So this equally actually would in fact apply to someone like Jared, who's in Perth at the moment, but normally would live in Singapore. This individual had talking to us about his domicile. And that's very important for UK expatriates, because if they keep their UK domicile when they live abroad, then their estate is subject to inheritance tax, even if they don't live in the UK. And inheritance tax is 40% of your assets. So it's something that any British expatriate should think about once they live abroad and start to accrue wealth. And they were claiming that their domicile of choice was now Singapore, because they had lived there for the long term. But they weren't PR. This individual wasn't PR. They were on an employment pass. And when the restrictions came in back in March, April time, the first thing that the client did was he put his family and himself on a plane back to the UK. We were then talking to him about his domicile and his residence status, and that just threw up a real dilemma, because how can one claim that they've lost their domicile in the UK or Australia, but the first sign that their expatriate lifestyle isn't going according to plan, they jump straight on a plane and go back to their home country? Well, that suggests that that's where their permanent home is, and therefore where their domicile is. And then also from a residency perspective for tax purposes, the highest rate of tax in the UK and indeed in Australia is 45%, as opposed to 20% in Singapore. So if they spend too much time in the UK, then they could actually end up with their earnings and investment income being subject to UK tax. So thankfully, the tax authorities in UK, Australia, and other jurisdictions have kind of relaxed the residency rules, so that if you're spending too much time there as a result of the coronavirus restrictions on being able to travel, that they've sort of extended the period of time that you were allowed to remain there without being subject to the residency rules around taxation. But that's only as good as the restrictions last. So, for example, the last time we did this, Jared was stuck in Western Australia with no way of getting back to Singapore because Singapore was closed. So therefore, ATO relaxations would apply to his situation. But now that Singapore has opened up and there's no requirement even to do a quarantine, for 2 weeks now, if you come from most parts of Australia, apart from Victoria, then there's no excuse for him to be there. So if your position is that you're quite enjoying the fact that you're living in the UK or somewhere else because you've got a big garden and plenty of space around you, and the thought of going into another lockdown in a small apartment in Singapore doesn't appeal to you, well, I don't think that the tax authorities would have too much sympathy for you going forward. Another example is someone, again, very, very typical of a client, happens to be an Indian in this, Indian national in this example, but someone who claims not to really live anywhere. They spend enough time outside of India to have broken Indian residence status, has a business in the UAE, had family, and I think his children were being educated in the UK, so he had property that he could enjoy while he was there, and he basically was what we call in the business a fiscal nomad or a permanent, perpetual tourist. When the restrictions happened, he was effectively locked out of the UAE, where he spent most of his time, because he had no right of abode in the UAE, and was very much impacted from a business perspective. He was in the garment trade, if I remember, and that all came to a complete standstill when his customers cancelled all of their orders. So he was currently, and as I suspect he's still currently in the UK, but he doesn't have any right of abode there. So at some stage he will have to go somewhere, and his home is India. I kind of use the phrase that your true home is the place that has no choice but to accept you when you turn up on their doorstep. And if you are claiming that kind of fiscal nomad status, then really it's your citizenship that will determine where you eventually are connected to. But this individual could actually also be already impacted by the new rules that came in to force this year in India, whereby they're moving more towards what looks like a US position, that if you're a citizen of India and you're not liable to tax anywhere else, then you are deemed to be a resident for tax purposes of India. And that's frightened a lot of people like this customer. Maybe you're one of them if you're listening. That if you're an individual who lives, an Indian national who lives in a country that doesn't levy any income tax, then you should be quite worried about this. Thankfully, when it comes to places like United Arab Emirates, where there is no tax, the government have clarified that if you're bona fide resident and working there under a work permit, and you're registered with the authorities, then that this new rule wouldn't apply to you. But if you have business interests there, or you have an apartment there that you use without formalizing your residence position, then you're probably already caught by these Indian worldwide income tax rules. So hopefully with those examples, it kind of raises a few issues around how the post-COVID world might impact global expats, particularly around will it raise issues around your true residence and domicile status. If you're, as we've seen very locally in Singapore, if you're resident in Malaysia but working in Singapore, what people have found is that actually when the border restrictions went up, that they actually had no legal status in Malaysia, albeit that their children might go to school there and they have a property there. So that will drive people to regularize their resident status abroad a lot more formally if they move around those sort of global traveler and fiscal nomad status. One thing is clear, and it's already coming out from various governments around the world, that the cost of all of these restrictions and furlough schemes and income replacement schemes that we've seen in places like UK, US, and Australia, someone's going to have to pay for all of that, and it's inevitable that tax will rise, and attempts to avoid your tax liabilities will be increasingly frowned upon, and there will be a lot more international enforcement around exchange of information and tax penalties for non-compliance. Less tolerance for people who do claim to be resident nowhere for tax purposes. So everyone will need to have some form of home base in which they are resident and paying their fair share of taxes. And what I've seen also is that a lot of the discussions that I've been having recently have been around estate and succession planning. It's never been so important. All of those conversations that you've put off in the past about making a will and getting your affairs in order have now come to the forefront, just as a result of all of the stories we're hearing about all the kind of misery and death that is around at the moment. So focusing in on that, what can you do? Well, I mean, the very basic starting point is to make sure that you do have a will. Less than 2% of the population in most developed countries have actually done this. So it is a really important starting point, is to think about how you want your estate to be distributed, when you want it to be distributed, and who to, and which jurisdiction do you want to govern the distribution of your estate, particularly if you do move around various jurisdictions, or if you have assets in different jurisdictions, then it becomes much more complex, and you should really think about that. A lot of people have reviewed their retirement plans. Back in March, most people were saying, well, I can't afford to retire because markets have taken such a dip. Now people might be thinking, well, actually, my priorities in life have changed and maybe I wanted to retire a bit earlier. So it's making sure that you review those plans. And then also review where you have your assets. Those clients that I threw up as examples are very typical of people who invest with us. And regardless of what else is going on in their personal tax situation, then they were, quite comforted with the fact that they had their assets based in Singapore with companies like Friends Provident International, that they were in tax efficient structures, so that if they do get caught by tax rules because they've stayed too long in their home country, that they work for a tax perspective in that country, and they can have access to the money quite easily without causing too much trouble or cost to them. Particularly if their business was impacted, then I've seen a lot of people who have needed money in an emergency, and having that investment insurance in place has been an easy source of income for them. And then also, if you are from a country where they do levy inheritance taxes, like the UK or the US, for example, have you planned for it? Because it is normally levied at quite high rates that your heirs will have to deal with. And what we do with insurance wrapped investment is that we can help people to solve a lot of these problems locally in Singapore, to set them up for wherever their long-term plan takes them. And the reason why insurance wrapped investment works, so let me just take a little step backwards. An insurance wrapper, or a private placement life insurance, or an insurance bond, all the sort of terminology that you might hear that's a bit technical, is basically an insurance policy where the benefits are linked to investments and the performance of those investments. So unlike a traditional insurance policy, which you'll probably hear from the other speakers around critical illness or pure death insurance, it's not linked to human life in the sense that you have to wait until there's an event such as illness or death for it to pay out. You can surrender it at any time, and it's more like a pension. It holds investments, and then you save in those in that wrapper until you're ready to take the money out. And it can hold various asset classes, direct equities, mutual funds, ETFs, and bonds. So to show how it works from a tax perspective, it's, to compare it to someone who just invests directly. So if you live in Singapore, for example, you'd be familiar with something like iFast, which is a wrap platform. What you're in fact doing there is you're investing directly into the underlying investments. Even though the platform is doing it on your behalf, you are the true beneficial owner of those investments. And that's not a problem while you're living in Singapore, because investments are not taxed. So dividends, income, capital gains, etc., are all tax-free while you live in Singapore. But that's not the case if you move around. If you go to Australia, UK, India, South Africa, for example, then in all of those jurisdictions, they have a worldwide tax system. So it doesn't matter whether your assets are offshore or not, you still have to declare them and pay tax. And investment income and capital gains are not exempt from tax. You have to report them every year and pay taxes on those returns. So that depletes overall the value as it's accumulating before you need to take the money, or you want to take the money. Also, there are issues around automatic exchange of information. So the platforms need to report each individual line of stock, for example, and each income or capital gain return every year to the tax authorities, who will swap that with other tax authorities around the world. From a succession planning point of view, if you own equities in a foreign jurisdiction, then the correct way to deal with that on death is to go through their local probate system, and possibly be subject to their estate duties as well. With private placement life insurance or an insurance bond wrapper, it is the same underlying investment strategy that you follow. So whatever investments you're holding in accordance with the recommendations of your advisor, then it's exactly the same as holding them directly. But because they are within the insurance wrapper, the investor is removed both legally and beneficially from those investments. So that means that all of the income, the dividends, and the capital gains all roll up within the structure. And generally, in most parts of the world, the insurance wrapper is recognized as an accumulation vehicle. So there is no ongoing tax reporting or tax liability whilst the money is rolling up before you have retired. So only when you take money from it is there a tax impact. So that allows you to defer decisions around taxation, and actually very handy for people who are stuck back in their home countries at the moment, because if they do become resident in their home country for tax purposes, they at least know that their retirement pot or their family trust fund pot is not going to be impacted by those residents rules biting them. So structuring through insurance gives you these advantages around tax-free inside build-up. Also, in a lot of countries, not only do they recognize the insurance as a tax-free build-up wrapper, but also when you take money from it, generally there is a specific set of rules that can result in a lower tax rate than the normal headline rate of income tax. And if you've got inheritance taxes in various jurisdictions, they can help solve some of those problems purely by structuring in this way. I mentioned that estate planning is important. It's also good to know for a lot of our customers that in Singapore there is a very simple framework from which you can nominate beneficiaries using insurance, and it's legally protected. And that means that people have got the comfort that should something happen to them, that their heirs can get access to this money very quickly, very seamlessly, without going through lengthy probate processes. And even if you only need to do one set of probate, for example, in Singapore, well, that can take between 6 months and 2 years, depending on the complexity of your estate. If you then multiply that by various jurisdictions in which you hold money, then it can create a lot of unnecessary cost and delay for your heirs. So the ability to just nominate a beneficiary to make a claim is a really, really important benefit for a lot of people. And it all helps to simplify people's affairs. So why is tax important? Well, I've mentioned a few jurisdictions, Australia, UK, India, South Africa. And the reason why I've mentioned these is because they form the vast majority of the client makeup of our own business. They're all expatriates who are represented in large numbers in the places where we are licensed to do business. They're able to contract in English, and a lot of the technical concepts are all based around the same sort of original legal framework. And also what they've got in common is that they're all very high tax jurisdictions. So you can see that, certainly UK, Australia, South Africa, it's almost as if they copy each other when they introduce new tax rules, and their headline rate of income tax is 45% and above. India is not far behind at 35.88%. They all have a worldwide tax system, so that it's not enough just to hold your money offshore. You've got to structure it properly. And one way you can do that is to minimize your tax exposure by using insurance wrappers. And UK and South Africa also have estate duties that can apply to you, that can be solved, and those problems can be solved with insurance wrap. I'll not labor on this slide, but effectively what it means is that instead of paying a headline rate of 45%, it is possible to pay rates that are a lot lower than that. In UK, for example, I commonly structure people's investments so that they don't pay anything for the first 20 years of retirement, and even in the later years they never really get above 10% headline rate of tax. In Australia it's very easy. If you hold the policy for more than 10 years, then that wrapper is completely tax-free if you draw down assets, draw down income while you're living in Australia. In India, the headline rate drops from 35% maximum to 20%, and in South Africa there's a maximum rate of 18% as opposed to 45%. So these are one of the main reasons why someone would use an insurance wrapper while they live in Singapore or abroad, with a view to going back to retire to one of these jurisdictions. And they do work in other countries as well that I haven't covered today. So if you're in the fortunate position that you are resident domiciled in Singapore and always have been and always will be, then you're wondering, well, why am I interested in this? There is, that is a good position to be in, because obviously investments are not taxed. There's no inheritance tax in Singapore. But if you live there and you invest outside of Singapore, then you need to be careful about what I call the hidden exposure to taxes, and particularly to inheritance taxes. And I'm using a few examples here that come up quite a lot. Is someone will have a portfolio of shares that will naturally, for diversification, hold some of the proportion of that in US equities and some of it in UK equities. And in that case, even if you have no connections to the US or the UK, you could be exposed from an estate perspective to their inheritance taxes. Just to sort of show you how that would work is that if you are a US citizen, then thanks to Donald Trump, you are able to avail of a very high minimum tax threshold before which your estate is subject to estate tax. 11.58 million free of is free of inheritance tax at the moment. And if you transfer your money all to your spouse who is also a US citizen, then there's no inheritance tax on the first death, and they can inherit your exclusion amount as well. So $23 million per couple can be transferred to your heirs before you need to worry about inheritance tax. So it's only the very, very wealthy who need to worry about estate duty from a US perspective. If you are a non-resident alien, as the US, very charmingly call anyone who's not a US citizen, and you own US assets, then you don't avail of that 11.58 million exclusion amount. You have a maximum exclusion amount of 60,000 US dollars. So complete peanuts compared to what the usual exclusion amount is. And that applies to US equities. And I just read an interesting article before I came onto the webinar on Bloomberg that was estimating that over 6.5 trillion worth of US equities are held by non-resident aliens. And the figures from 2014, which is the last time that they've updated the figures from, even though you've got that amount, $6.5 trillion worth of US equities held by foreigners, only 349 estate tax returns were filled in by foreigners in 2014. Now, if governments are going to be looking for extra money to pay for all of the coronavirus restrictions, that to me would be a very obvious place in which to look, because there's a lot of non-compliance going on there. Likewise, in the UK, it's very similar in that transfers between spouses are exempt from IHT, as we call it, inheritance tax, and the unused part of the nil rate band can be transferred between two spouses. But the nil rate band is a lot lower than what you would see in a US context. It's 325,000 sterling is tax free, and then anything above that is taxed at 40%. So to give you an example of how that might bite someone who lives in Singapore, you've got a Singapore resident, also a citizen of India, intends to go to live in Australia at some stage during retirement, holds a very wealthy individual, but it happens that some of his share portfolio is in the US and some is in UK, $1.5 million and 1.5 million sterling. So looking at the US position, if Sanjay passes on, he's got a $1.5 million worth of US shares. He only gets an exclusion amount of $60,000 because he's left that to children, which means that 1.4 million is chargeable to estate duty. And as you can see, the US position is that you put that money through quite a complex layer of thresholds. But the figure in red is the one to look at, which results in a third of the value of the portfolio being taken in US estate duty. And then likewise, the UK side, assuming that he inherited his nil rate band from his spouse who passed away, 650,000 sterling can be left free of tax, and then the rest is taxed at 40%, resulting in a £340,000 inheritance tax bill. So how could you easily solve that? Well, that's where the insurance wrapped solution that you can get in Singapore is, really comes into its own, because you can transfer those shares and any other assets into the structure. You can now simplify the disposition of that on death by nominating the children as beneficiaries. And because it's the insurance company that now own the assets and not the individual, so Sanjay has divested himself of legal and beneficial ownership, that there is no death event on his passing. The insurance company is entitled to those assets. An insurance company doesn't die. We pay out that money quickly to Sanjay's children with no delays in probate, no tax returns to fill in, and all completely legally and legitimately. And it's basically saved him quite a lot of money in inheritance tax in the meantime. And also, if he moves around and becomes resident in either Australia or India in the future, then it also acts as a tax shelter that doesn't need to be disturbed when he comes to that point. So hopefully I've sort of wrapped that quite a complex subject up in in a simple way for you. Obviously, there's a lot more detail that we could go into, but if there's things there that you've heard that apply to you and you want to know more, the main thing is don't delay taking action, and also make sure you seek the help of an independent financial advisor like Jared, who can pull all of this complexity together into a recommendation that applies to you personally. With that, I'll pass back to Jared, and thank you.
Thank you very much, Brendan. Look, certainly a lot to cover. I hit on a few points that are very close to home for me, obviously. As Brendan highlighted, I have reached the end of my ability to stay in Australia. As was outlined, Singapore has let us back in, so we must leave the country now. As lovely as Australia is, if we do wish to continue paying tax in Singapore, it is time to get out. But there are a lot of people, I feel, that are stuck or choosing to be stuck in various parts of the world that really need to take a good hard look at what their tax exposure could be. And particularly as the world starts to reopen, as restrictions start to relax, I think a very good time to actually start to look at a lot of these things, Brendan. I think you raised a very valid point there. And then around, inheritance tax, ownership of existing assets. Even Australia is now talking about inheritance tax. Now, it is softly, it is, sort of external politicians and commentators talking about inheritance tax, but we need to be constantly on top of the ownership of our assets and thinking through, how we distribute these
definitely
things.
I've seen a couple of things that are quite important for Aussie expats to think about. In addition to the inheritance tax one, there's been quite an important residence case, the Harding case, that has resulted in them now looking at whether they bring in a statutory residence rule. And although they won't admit it, I suspect that they will copy the UK statutory residence rules quite a lot. So that will throw up a lot of questions for Aussie expats on how they manage their days in and out of Australia going forward. And then the other one I've noticed recently is that they've turned their attention to pension arrangements. And specifically something like the CPF in Singapore, which has been to date recognised as a pension for Australian tax purposes. They are looking at removing that recognition, which could cause problems for people who go to Australia with a CPF in future.
Yeah, no, it's an excellent point, Brendan. I think it's one of those things that needs to be constantly reviewed. If you had a plan designed 5 years ago, it's too old. To be honest, it's time to revisit all of these things because they're changing quickly. And to Brendan's point that was raised, governments are spending an awful lot of money. They are going to need to find ways to top up the coffers and replace a lot of this money that's being spent, and they are going to be looking in every which direction. So certainly time to seek advice. And certainly while you're in Singapore, while you are in a relatively tax-friendly environment, with no capital gains tax, no tax on dividends, certainly a very good time to consider ownership of assets for wherever your future residence may be. So hopefully everyone's taken a lot away from Brendan's presentation, and thank you very much, Brendan. Now we've had a few questions around ownership for different citizens. I will just park those to the end because otherwise I'm worried that we may never get off this ownership discussion and never get to our other speakers. So if everyone's okay with that, I have made a note of them. We do have them there. We will certainly touch on them a little bit later. But I'd like to change tact a little bit, and I'm going to hand over to JM. Now, JM is the head of private clients with Expat Insurance. He's worked in the industry for over 12 years in personal insurances, worked with Zurich Insurance Group in Switzerland, certainly an expert in personal insurances, and he's going to share with us a bit of framework around what to consider as both expats and Singaporeans when it comes to our wealth protection strategy. So JM, over to you.
Thank you very much, Jared. Perfect. Let me just check with you guys if you can see my screen now. Perfect. Just a second. Okay. Good morning or afternoon, evening, everyone. My name is J.M. Season, and I'm the head of private client at Expat Insurance. I'm here to provide you a short introduction of Expat Insurance on who we are and what we offer. And I'll be highlighting to you the importance of having adequate coverage, especially here in Singapore. Afterwards, my colleague Ethan will be giving you a presentation on life insurance, critical illness, and cancer insurance for you all to have a better understanding of those insurance products, and more important, to understand the importance of having such coverages. Go to the next slide. I see the whole presentation still. Is a slide? Oh, here you go. Okay. Is it better now? Yeah, perfect. We provide advice and brokerage for global professionals. So we're an insurance broker, and we were founded in 2009 and are part of the CIASI Saint-Honor group, headquartered in Paris. Although we are based in Singapore, we provide coverage globally, may it be local and/or international solutions. As a broker, we're here to understand your situation, needs, and requirements, and provide you trusted advice and find the best insurance policy for your needs. We're a team of around 30 people, and our office is at the Riverwalk, where the MOM, the EPAS Service Center, also is. So it's in between Boat Quay and Clark Quay. Okay, next slide. Just want to share with you our vision, mission, and goal. So our vision, well-protected and healthier global professionals. Our mission, to provide our clients the best health and protection advice, solutions, and services. Our goal, or our ultimate goal, is to be recognized by our clients as your trusted insurance advisor. Go to the next slide. Okay, so we're not just a usual insurance broker with maybe empty promises, but we have also been recognized by these institutions such as Expat Living, Insurance Asia, for our service and trusted advice given to our clients. I'm actually really proud to announce that for 5 years running now, we have been awarded the Singapore Broker of the Year Award by Insurance Asia. Let me introduce you my private client department. We have a team of medical insurance advisors where you get excellent advice on your health or medical insurance needs. May this be a maternity cover, dental cover, or a top-up for those clients with an existing employee benefits or so-called EB plan from their employers. Please do note that there may be gaps in the coverage that your employer is currently offering you, meaning it's even more important here in Singapore, where the hospital bills can be really, really expensive to have adequate cover, right? Did you know that giving birth in a private hospital in Singapore can cost you up to 15,000 Sing dollars? Well, actually, a C-section around 20 to 25,000 Singapore dollars. Also, being in a private hospital in Singapore for a medical or a surgical specialist can be very expensive as well. May this be for an accident, for example, or cancer, heart diseases, or pneumonia. So I've checked out the prices. The average cost per day at the private hospital would be around 1,300 to 5,300 Sing dollars. In terms of average total bills, it's around 4K for a short trip at the hospital, or up to 25,000. So that obviously depends on your stay at the hospital. Okay, should you not be sure on your current coverage or EB coverage from your employer, please do reach out to us so that our advisors can review your needs and or your EB plan and suggest any top-ups or necessary coverage. I also have a home team that covers all home and content insurance related matters, such as a simple home insurance, art coverage, for example, or a buggy coverage, up to jewelry insurance. Lastly, I have a life team advising you on the important aspects of life insurance. Ethan will be giving you a more in-depth introduction to the importance of life insurance later on. We also have an employee benefits department that provides employers all coverages required for their employees. My colleagues from the EB team will be happy to provide you tailor-made group plans for your company, basically for your employees as well. So you can see here different kinds of group plans. It could be a group life, for example. And lastly, go to the next slide. We've also got a business department and or a P&C, property and casualty department, that offers businesses all insurances required. May it be a P&C coverage, a simple SME package, or PI for professional indemnity, D&O, directors and officers, cybersecurity, etc. Okay, for us being an independent broker, we do not advise our clients to select the insurers based on the partnership we have with those insurers, but actually based on your needs, the insurance needs of our clients. Here is just an overview of all our insurance partners that we work with. Thank you very much for listening in. Please find our contact details here before I pass it on to my colleague, Ethan, from the live team. So for individual or private client inquiries, please call us at 6401-9201 or just drop us an email at info@expatinsurance.com.sg. Thank you.
Wonderful. Thank you very much, JM. Yeah, very, very useful background on expat insurance there. And we've certainly worked with the team a number of times now, and both personally and with our clients. and found the expertise there very, very helpful. I think you've raised a few excellent points there, particularly around gaps in employee cover. And it's sort of one of those things that a lot of, we notice with a lot of our clients that come on board, just don't review, just assume that their employer cover will be enough, or that it will cover them globally, or simply ignore what happens when they leave their employer, voluntarily or involuntarily, as COVID has certainly highlighted. So certainly some homework to be done there, as well as the fact that I think as a lot of people will know, hospital bills, amongst most other things in Singapore, can be ridiculously expensive. So on that happy note, let's dive into, I guess, a little more of the detail and some of the practicality around the insurance options. So we'll pass over to Ethan. Now, Ethan's been a life advisor with Expat Insurance for over 10 years, certainly an expert when it comes to term cover, term life insurance, disability, critical illness cover, as well as how it works for expats who may be departing or moving into Singapore. So Ethan, over to you. Walk us through the practicalities of what insurances we need.
Thank you, Jared, and good evening or good morning, wherever you are based. So my name is Ethan Lee. So yes, I've been with Expat Insurance for a number of years now. So I specialize in life insurance, particularly term insurance, because I am a strong believer in term insurance because it's the most affordable and I think it's the most cost-effective solution for protection-wise. And I'm here to share that term insurance should be made easily affordable for everyone, so that everyone should be able to actually get yourself covered or your families covered. Okay, with that, I will share my screen. Can you guys see my screen? No. Okay, perfect. Okay, great. So yeah, my topic today is what you need to know about life insurance and critical illness insurance. So what do we provide? We basically provide term life insurance with optional riders for total and permanent disability, critical illness insurance, as well as disability income insurance. So just to give you some definitions about what those basically cover. So term life insurance basically it covers death in a nutshell. So it covers it for a specific term, a specific period. So for most people, it could be till your desired retirement age, or when your dependents become no longer dependent on you. That means when your children grow up, have formed their own family, and no longer depend on you. So that's when the term actually stops. And then there will be total and permanent disability. So basically it's when you take your both eyes and your 4 limbs and you lose the use of 2 out of 6 of them. So I know this sounds very morbid, but of course, this is actually very crucial. I mean, touch wood, if this were to happen, this actually is the most devastating effect. And then moving on, we have critical illness insurance. So in Singapore terms, there's basically 36 critical illness covered. I mean, given by the definitions of the Life Insurance Association of Singapore. So basically, it covers things like cancer, heart attack, stroke, kidney failure, so on and so forth. And then lastly will be disability income. So basically, this provides a monthly income. You can treat it as a replacement of your income due to disability because of illness or accident. Okay, so moving on. So what are the benefits of life insurance? So touch wood, if you are not around, then you'll be income replacement for the years of lost salary your family will potentially get. So it provides for your family, their daily living expenses, even like college funding. So if you are a business, it can actually cover your key person. So your key person is the one you are dependent on profits. And then if touch wood, something happens to him, at least the business has this amount of money to actually tide over. And then lastly, you can actually provide a legacy for your estate. So if you wish to leave something behind for your family, yes, life insurance is actually the most suitable one, because it's the only instrument in the world that actually gives you up to like 1,000 times leverage. So for example, for as little as $100 a month, you can actually cover yourself for up to $1 million. So there's no such instrument in the world that can actually provide this. So particularly, I like this quote: life insurance is like a parachute. If you do not have it the first time, there is really no second chance. Okay, so moving on to the total permanent disability and critical illness insurance. So what are the benefits of it? You can actually pay for your daily living expenses so that you can actually focus your time and energy on getting well instead of focusing on your work so that you can stay on your job to actually pay your bills. So because if you are, touch wood, if cancer were to happen, obviously you will be too sick to work. So you'll be actually losing your income, and then you potentially have additional expenses to pay for the treatment. So it's like a double whammy. So this lump sum is actually very useful. So it maintains your family standard of living. And then for the TBD, you could actually maybe pay for your transportation expenses, and then installing like lifts in your home, or allows a family caregiver to actually give up their work to take care of you, or to hire a private nurse to actually take care of you 24/7. So yeah, another quote which I'm going to share is whatever excuses you may have for not having life insurance now will only sound ridiculous to your widow. So I mean, this is the true fact of life. So please just get life insurance for the sake of either for yourself or for your loved ones. Okay, so features. So for term insurance, it's very flexible. It's a global portability. So I mean, I understand you may not be in Singapore for the rest of your life, so don't worry about it. Even if you were to relocate in the future, this policy covers you worldwide. It's fully portable. So you can also choose from six currencies: the SGD, USD, the pounds, the euros, the Aussie dollars, and the Hong Kong dollar. And then there's flexibility to cover yourself up to age 99, and you can also stop the policy and terminate without any early termination costs. So it's actually, as I mentioned earlier, very affordable. For $100 a month, you can actually cover yourself up to $1 million. And the best part is for life insurance, the premiums are also fixed and level. So the earlier you start, you can actually lock in your premiums and also your health, and the premiums actually remains for the rest of the term. So right now, there's also a 20% perpetual discount now. So yeah, so another reason for you to actually get your insurance started early. Okay, so I like to focus on a few things for the critical illness. So I actually put this out from Aviva Life Claims 2019. So they actually paid out 48.8 million in 2019. So that's equivalent to about 134,000 every day. So a total of 1,200 customers have actually benefited from this life insurance and critical illness. And then moving on, there's a few parts for the claims. So there's the major claims, which obviously refers to like death, TBD, and there's critical illness, disability, personal accident, and medical. So I'd like to bring your attention to the critical illness part. So for the claims approved, you can see that compared to the rest, it's actually lower, 74%. So you may ask, why is this so? So because of critical illness, there's actually, if you understand that stage 1, stage 2, stage 3, and terminal stage. It means there's early critical illness, intermediate stage, and the late stage. So some clients may not understand, they just buy a late stage insurance, but then when they were discovered in the stage 1 or early stage, they are unable to claim. So that's why the percentage for it is actually lower compared to the rest. But if you see the amount paid, it's actually higher than the rest, even for death insurance. So why is that so? Okay, we'll move on to that. Sorry, yeah, I will. So why is that so? Because I believe most insurance are actually bought in their 30s or 40s. And then of course, with statistics, you can see that CI claims are actually claimed in your 30s and 40s or 50s. So that's why you can see that that's the most claims made in this age group. So if you look at the CI claims paid over the last 3 years, 2017, 2018, and 2019, it's obviously on the uptrend. So I'd like to pose this question: what do you think will happen 10 years later? So my belief is with the advancement of technology, so most people are actually going for like health screenings earlier, trying to catch the disease earlier. So I think it's fair to say that the claims will actually continue to actually be on the uptrend even 10 years later. Okay, so that brings me to the end of my presentation. So yeah, if you have any questions, you can reach me on the contacts. My numbers or my email are there. And then, yeah, that's all. So I will pass this back to Jared.
Wonderful. Thank you very much, Ethan. I think you've raised some really excellent points there around taking out insurance early. Certainly know Jim Cramer out of the US. For anyone who follows some of the US money market commentary, one of his #1 money tips outside of his hot stock tips is always buy as much disability cover as you possibly can when you're young. And it's often not then that we think about it. It's often when someone that we know or a loved one is sick or ill or has passed away, or when babies are on the way. And it's quite often these catalysts which can in many cases end up costing us a lot more, particularly if we're older and have any pre-existing health conditions. So yeah, really appreciate that. Yeah, I think you've also raised the point there that a lot of people are underinsured. We certainly see it with a lot of our expat clients, assuming that either they already have cover that's valid in another jurisdiction, or they just have enough cover elsewhere, or they don't need to worry about it. Certainly as a relatively young male, we all like to think we're invincible. And no matter how good our savings or wealth creation or retirement plan is, something can come along and wipe all of that out in an absolute heartbeat. And an unfortunate part of working in this industry is we see it far too often. So really appreciate both yourself and James' presentation this evening, raising and highlighting some of the importance of personal insurances. So guys, I will open up to questions there on that note. So if anyone has any burning questions they would like to raise around, around anything really, around structuring of ownership of assets, ownership of US shares, anything for expats stuck, anything around the insurance piece, please do let me know. Okay, so we'll tackle a couple of these. So JM Ethan, perhaps more one for yourself, Ethan. A question just around what happens for, let's just make it a little broader, an Australian, British, European expat. They buy trauma cover, life cover, disability cover in Singapore. What happens when they move home or when they return home or move to another jurisdiction? I guess, can they keep their existing cover? And I guess just to extend that a little further, what should they be thinking about when it comes to the currency risk?
Okay, so yeah, as I mentioned earlier, the policies we recommend will definitely be fully portable. So even if you were to relocate elsewhere to UK, Australia, or wherever that may be, it's still a worldwide cover. So don't have to worry about that. So as long as you pay the policy, you are covered. Simple as that. Yeah.
Okay.
So yeah, and regarding the currency risk, so of course there's 6 currencies for you to choose from. So if you want to, if you are very sure that you are going to move back to the UK or to Australia at some point, then it's actually better for you to actually take the policy in that currency. Yeah, but of course, even if you were to actually take it in Sing dollars at the start, you can actually convert the policy when you move back to your home country. Yeah.
Excellent. I appreciate that. And Ethan, while we're just on the personal protection, and particularly around expats, I might just throw in another question that we've had here from one of our attendees, just in relation to their existing employee cover. And I mean, I know we see it a lot as financial advisors. People come in assuming they've already got enough cover, they don't need to have any personal cover, and then they lose their job. Or even worse, they're diagnosed with an illness, a cancer or something else, and their employer then lets them go. What happens then to the rest of their cover, and what might be some, just broadly speaking, some strategies that they should be thinking about to sort of shelter themselves as much as they can from some of these potential events?
Okay, so my advice regarding corporate cover is actually to treat it as a bonus. So it's always better to depend on yourself rather than your employer. So it's actually the best thing is to get personal cover. So it locks in your health. So I mean, if you are perfectly healthy now, it's the best time to actually get life insurance because you'll be fully covered. So if you depend on your employee, so there's two things. One is not portable. So if you have to switch employee and touch wood in between, you will be you're diagnosed with, like, example, high cholesterol or high blood pressure, things like that. You may not be covered in your next employer. So yeah, my advice is to actually get it as a bonus and take it your personal insurance as the foundation.
Perfect. Excellent. Rely on yourself, don't rely on anyone else. So it reminds me of the famous quote, if it's meant to be, it's up to me. And I think that needs to ring true, and probably we need to be reminded of that sometimes. Brendan, we might throw one over to yourself. Obviously, the US stock market's had a very good run, so probably no surprises. We've got a few questions around US equities when it comes to employee stock. Mm-hmm. So the question is largely around, at what point or at what value does it become prudent to start looking at structuring of the ownership of those assets? You know, is it 50,000? Is it 100,000? Is there a line in the sand that people should start sort of thinking through how they might want to structure and own those assets going forward, particularly in relation to US?
Yeah, sure. Well, with the US equity one, it's quite an easy one to answer, in the sense that once you go above 60,000 US dollars, you start to face a potential for estate duty, which if you look back on the slide, I think it starts at 18%. So once, you know, obviously the structure that you put around your shareholding will have a cost to it, because it's an extra wrapper around it. So it would just be a case of working out where the pinch point is between the cost of the wrapper plus as opposed to the cost of the insurance, or sorry, the estate duty. But it's not just a flat figure of the estate duty that you need to concentrate on. It's also the cost of actually employing a lawyer or a legal firm to actually do that for you and go through the probate process as well. So a lot of people underestimate those costs. But at $60,000, as soon as you get to that figure, you should start to think about it. And that's only in respect of your US holding. Obviously, if you've got holdings in the UK or elsewhere, you've got to think about, you know, those as well. So it's the overall pot that is relevant, not just that little bit that you would have in the US.
Perfect. No, that's excellent. I think that gives a lot of people, a good sort of line in the sand. And I think certainly for a lot of our clients and expats in general, particularly given a lot of the generous share purchase plans and company sort of incentives that are on issue, I certainly think a lot of people would be reaching that critical line in the sand quite quickly.
Yes, and also what I've found is that if those shares have been given through an incentive plan, because, you know, obviously the best way to solve that problem is to sell the shares. When it's through an incentive plan, there's a much more emotional attachment to those shares as well. So people are loath to do that. This gives you the ability to continue to hold them, but not worry about some of those complications that go with it.
Perfect. No, that's excellent. Thank you, Brendan. Now, a little bit of a curly one, and perhaps we can just answer this broadly. I'm mindful that's nearly 7:15 by my watch. So, Brendan, just I guess a broad take on this one. Private equity, private company ownership, private investments. I think we've seen quite a lot of interest, certainly just amongst conversations with our clients over the last 6 to 12 months, whether it's buying sort of car rental businesses, a car wash, self-storage, whatever it might be. Is it possible to wrap these sorts of investments into a structure like the insurance bond that you mentioned earlier?
Yeah. Well, the short answer for us is no. We concentrate on what we call bankable assets, so things that are listed. There are other providers out there that will look at private equity holdings as well. But generally, what you'll find is with private, certainly if they're in jurisdictions like Australia, or places like US, UK, where there are inheritance taxes, which is generally why you would do such a thing, that there's incentives to hold that type of asset anyway, because it's a recognition that you're taking more risk, and that you're possibly creating jobs as a result of holding that sort of asset. So normally they will benefit from what we call business property relief of some sort, which will exempt that type of asset from inheritance tax. So there's not the same incentive to wrap them as there is with bankable assets, which usually carry no tax benefits or tax exemptions at all. The only thing to watch with private equity then is that if it does benefit from a sort of a business property relief system, that you are mindful that you will need to plan when you sell out of it, because you will suddenly have what I would call sort of an escalation event, where your estate suddenly is exploded with value and with tax liability, because you've now come out of that exempt asset.
Perfect. No, I think that sums it up nicely. Gents, I might just throw to our final question that I've got here, and one for yourselves, Ethan, JM, on the insurance front. Let me just word this as succinctly as I possibly can. I'm young, I'm single, and I have no dependents. Why on earth do I need to think about insurance?
Okay, maybe I'll take this. So yeah, as I mentioned earlier, life insurance is actually dependent on age. So the earlier you start, you first of all, you lock in your health, because you are perfectly healthy, hopefully, when you are still young. And then you also lock in the premiums. So yeah, the premiums are actually fixed and level for the rest of the term. So it could be the next like 20 or 30 years, and the premiums doesn't actually change over that time, compared to you actually waiting like maybe 10 years or 20 years later to get it. The insurance cost will be very expensive. And then by then, you may have developed some pre-existing conditions, making you ineligible to actually get the life insurance. Yeah.
Perfect. Wonderful. Very well answered, Ethan. I appreciate that.
Okay.
Well, ladies and gents, we might wrap up there. We've not got any more questions come through. So if anyone has anything else to add, we will be sending out the recording of this evening's webinar or this morning's webinar, depending on where you happen to be. So you will have our details as well as our speakers' details. So if you do think of any other questions, as curly as they may be, or if there's just anything that you didn't want to ask on the webinar this evening, you will be able to fire them through. But I would certainly like to thank certainly our three speakers this evening. It's been very informative. We've had a good range of topics covered tonight. So a virtual round of applause to our speakers. Thank you very much for joining us. Much appreciated. I hope everyone who's joined us this evening's got a lot out of it tonight. Hopefully there've been some good takeaways, and we look forward to the next session. So thank you all very much, and we look forward to speaking with you soon.
Thank
Take
you.
care.
Thank you. Goodbye.
Thank you.
Pleasure.